we're going to close on the business and the 60% covered on the business that I touched on the previous video. And now we're going to shift to financials. So the next 30% of the analysis. So here is an important aspect to learn about from UiPath. They are on a roll. However, they provided a very soft guidance for next year. And so it kind of like it was a mixed quarter, you could say, because the quarter itself was very impressive with acceleration. And you can see here, this is sequential growth. So this is how much new annual recurring revenue they are adding every quarter for the past, 8 quarters. And this here is their guidance for the next quarter. So you may not notice they are closing their fiscal year end of January. It's one of those companies. And so it's a quarter that has November, December, January that just closed here. And so this next quarter, what they call Q1 FY23, is actually February, March, and April 23. And so as you well know, Russia started invading Ukraine basically 1 month into that Q1 23 quarter. And I'll touch more on why that impacts UiPath significantly. But basically, I look at this guidance as also a warning sign, if you will, of things we're going to hear about in the next earnings season, because most companies, they close end of December, right? So they have yet to report their Q1 and to tell the stories around how the current war is affecting their performance. For UiPath, it's already out there. Everybody knows. And the market reacted very negatively. The stock actually fell more than 30% after earnings. And we could speculate, just for fun here, you and me, we could speculate that other companies are going to have similar issues, but we have yet to see it. And so maybe this is a warning sign here. It's hard to know, right? UiPath is heavily based in Europe. 30% of the revenue comes from Europe. So they are more affected by this trend, but something to keep in mind. And so this looks pretty bad, right? At face value, plus 4% is much less. So the question I had when I saw the earnings report, right, was, okay, why is this so low? Is this the beginning of a bigger issue for the company? Are they losing steam? And the Q4 quarter is so good that makes me believe that something is off with Q1, right? So management actually broke down the reason why. They provided their guidance, and they try to quantify the impact of the Russian invasion of Ukraine, as well as the foreign exchange impact. So if I give you the long story short, management thinks Q1 FY23, so the quarter where the war started, is really heavily impacted, but that things are going to get better from here for the rest of the fiscal year. And so the net ARR additions were plus 65% in FY21, plus 59%. So barely any slowdown. That was very strong. And right now the guidance is only plus 31% in FY23. So the next 12 months. This is a potential, issue with the thesis, because if the growth slows down too fast, it would mean maybe the competitors are taking over market share or something is wrong with UiPath. However, that is not exactly the case here, because the reduction in guidance comes from macro events that are not related to the quality of UiPath's business. They are related to other things, right? So again, FX rates and the Russian invasion. If you retreat those numbers, they would have actually provided a plus 35% guidance. It would still be a little soft, but historically, and I pulled this from Sikingalfa, this is their revenue surprise, meaning how much they beat Wall Street estimates. And on average, they beat it by more than 5%. So they tend to sandbag a little bit their guidance. So that's also an indication that maybe it's just that their number is a bit conservative. But we cannot know for sure. And so 30% I'm sharing here from their 10K, 29% to be precise, comes from Europe, Middle East, and Africa, their revenue. So of course, over there, people are, adjusting their spending. They are reassessing their risk, and it makes sense that they lower their software spending. From an operational perspective, UiPath was founded in Romania. That's why it's considered an international stock and not a US stock, even though they are headquartered now in the Bay Area. So 24% of employees are based in Romania, and you're based in London, so you have a great sense of European geography. But for those who may not know, Romania shares a border with Ukraine, right? So that's a tricky situation and another risk to keep in mind. We don't know yet how things could escalate, right? That's also the beauty of investing, I guess, is to step in the unknown, but that's a legitimate risk that could damage potentially the thesis here. So when I look at these numbers, I feel like, okay, the numbers at face value are bad, but as someone like me who invests on a 5 to 10 years or more time frame, this is exactly the kind of opportunity I look for. The stock falls down hard on news that appear to be temporary by nature. That's exactly what I want to see as an opportunity, because then I get to buy at a cheaper price for something that ultimately has the same long-term value. However, we have to recognize that in this guidance, maybe there is more to the story. Maybe, just maybe, management is like, oh, this is not looking good. Management touched in the call, the earnings call, about how some people in the US, some customers have expressed concerns. So we want to be mindful of that.
I think you have mentioned something very important, that the guidance, which was very surprisingly low, is mainly coming from external factors. So we can call it macro. But I want to ask you one question related to this guidance or the future of UiPath. When I invest in software companies, we usually call it the SaaS groups. So one thing I worry about is these days there are so many different startups and then softwares and solutions coming out. And from a company's point of view, you have so many different applications you have to buy. And for example, Zoom could be a good example. Yes, Zoom is great, but you have to buy Zoom, you have to buy UiPath, you have to buy CrowdStrike, you have to buy Datadog, so many different software companies. So from company point of view, it's too complicated to manage. So I would prefer to have one company who provide everything. And we could see that one of the competitors UiPath have is Microsoft, who can replace Zoom, who can replace UiPath, who can replace CrowdStrike altogether, because they have a bunch of different solutions within one package. Would you consider that as a big risk to invest in UiPath?
I think that's an excellent point, Charles. It's one of the risks that exists, the competitive pressure, because UiPath is already a clear leader. And so they only have room to fall from there, right? So that's something that could diminish the long-term thesis, at least impair it partially. I think we've witnessed it. I try to think of a company like Slack that was acquired later on by Salesforce. Slack has Microsoft Teams as a competitor, right? So it's a perfect example of things that can happen. Microsoft doubled down on Microsoft Teams, and they ended up having a very good product, right? So did Slack disappear? Not really. They continued to do well. They were acquired by Salesforce at a premium. And today they continue to thrive because we know that Salesforce had a few very strong quarters, and they attributed it to an extent to the fact that Slack is doing well. So when I observe this, and I think having been on the corporate side of things and having been a Microsoft Teams one of the users when it really popped up, I've witnessed that Slack didn't go away. It actually continued to do okay because it had that legitimacy already built in. So I think those things are not mutually exclusive, meaning we could have Microsoft thrive at some point if they manage to expand their automation solutions. That doesn't necessarily mean that UiPath would become useless, right? Or that the long-term growth story would be completely impaired. But that's an excellent point and a risk that we want to keep in mind. So we look at the ARR growth over time. If we see that Microsoft is shifting toward the leaders in, all the intelligence provider we discussed previously, if we see that the ARR growth is slowing down faster than we thought, that would be a sign that we need to hold off, maybe not add to the position anymore. That would be at least the way I handle it, or we keep position sizing in check if we have evidence that they are hurt by their competition.
Yes, good points. Great, thank you.
So we just covered the strength of the business with the growth. So the second part I look at with financials is the scalability. And so UiPath is spending an absurd amount in sales and marketing. Look at that, 60%. It's less than it used to be. It used to be close to 100%. So good news, it is leveling off at this point, it is 60%. Why do they do this? First of all, they can afford it because you can see here, they have a stellar, best-in-class gross margin, 86%. It's been relatively stable, actually slightly improving lately. This chart that I use Y chart for it, this is GAAP, right? So this is really following accounting principles. And this includes stock-based compensation, or SBC for short. So the spike you see here, this is the quarter the company went public, where you see the SBC impact. And so that's something to keep in mind, because around a IPO, you have a lot of bonuses and awards attributed to sales teams, marketing teams, among others. And so that affects a little bit, that bumps it up. It's actually good for us as long-term investors because it makes the financials look worse. And so people who have a short-term mindset may not realize that things are going to level off and improve shortly, and they would disregard the company. So that's another aspect to consider, keeping that long-term mindset and focusing on how will it look like down the line, right? And so that's why you see this big improvement here. It's mostly stock-based compensation that has gone lower because it leveled off from that IPO. So still losing money, that's another big risk factor that we need to talk about today. This company is losing money still at this point. And the way they do it is they allow themselves to spend a lot on sales and marketing, because what they see in their numbers is that after 2 years, they recoup that number because customers keep spending more. And so this is this idea of the predictability of the business that I love to see. I have witnessed it in gaming, because in gaming, when we acquire customers, we are sometimes willing to spend $5, $10 to acquire a new user on average, because we know that on average, they're going to spend more on the game. So you got to spend money to make money, right? That's the old adage. And so this is exactly what management is doing here. They are willing to still have negative profitability because they know that the long-term trend is going to get there, and we can already see it, the early signs of it. One thing I want to touch on is just the non-GAAP metrics. So non-GAAP excludes stock-based compensation. So that's not really interesting for us. We want to see the real actual profitability. So I wouldn't say that just because they are non-GAAP profitable, which is the case here. What we really want to see over several quarters is just how non-GAAP evolved, because since it excludes non-recurring costs. If non-GAAP slightly improved, that's actually a better sign, a more important sign, right? So here it was mostly flat. It didn't move much. And again, we want to see the trend over several quarters, right? So we are still in growth mode right now for UiPath, but minus 18 in the past quarter is actually not too bad compared to, let's say, Unity has actually worse margins, right? So that's something to keep in mind. But the past year looks really ugly because it has the SBC related to the IPO. The last point on financials is sustainability. This is a factor that could make me not invest in a business if it doesn't look strong. And thankfully, UiPath really does well here. At the top here, you see their cash and short-term investment. They have 1.9 billion. And this is at the bottom, mostly their long-term debt. They have a cap lease obligation. So that's about 50 million, so close to zero. So they have 1.9 million, mostly coming from the IPO, in cash on the balance sheet. And so if we look at the past 12 months, the financials, they have used, so that's negative, that they have used cash from operations about 50 million and 68 million used in free cash flow. So that's bad news, right? They are using cash as opposed to generating cash right now. However, what I always do is I compare this to the overall cash on the balance sheet. So right now, they could go on like this. They won't, right? Their margin will improve. They are going to scale up, right? But even if they continue to lose 50 to 70 million in cash, they could do that for 30 years and they would still have cash on their balance sheet. So it doesn't mean we want them to do that, but at least it shows that I have no concern on the sustainability of the business right now. I know that they are good to go. They can continue doing that and fund their growth path. Okay, we're almost there. The last point I want to cover is the valuation. So this looks pretty bad. It shows their valuation since they went public. So this is the IPO here, and they were valued above 60 times revenue. So this is trailing revenue in purple. And in orange, this is their forward revenue, so next 12 months revenue. So you can see how UiPath today is valued at about 9 times their past 12-month revenue and 8 times their next 12 months. And if we go to the following 12 months, so those are estimates, of course, right, from Wall Street, it's probably at about 6 times. So I want to touch on that because what I like to show when I do this is how if a stock stays flat, and let's say there is no dilution because they're going to end up like generating a bit of cash eventually, they will grow into their valuation, right? Just matter of factly with their revenue improving, their margin and spending, they're going to justify their valuation over time. That's why we are willing, when we invest in software stocks, to pay up for quality. So the way I think about it is I have some of the smartest investors on planet Earth right now, and you can see it there. Sequoia Capital, Tencent, we have Kuatu, later on Altimeter, Brad Gerstner invested, Tiger Global is there. So you have so many VC funds, hedge funds that have invested in this company. They are all loading the truck. They all believe this company has tremendous potential. But guess what? Most of them have invested during the Series F valuation, February 21. At 35 billion valuation. So today, this is the $8 or $9 billion company. Of course, these people bought at the top because you and I know February 21 was actually the peak for many growth stocks, right? Sure. Because of the macro environment, we are way down right now. And so I find it fascinating because the merits of the business are mostly unchanged. We have this macro issue right now with the war, but we get to invest in the company at like 60 or more percent less than what some of the smartest investors in the world have been willing to pay for just about a year ago, a little more than that. We pay actually less than the Series E here. It was 10 billion, so we are less right now. When I see this, I don't see it often. When I see it, I am very happy to start a small position because that tells me the margin of safety is here. It doesn't mean I'm guaranteed to make money. It never is the case, right? But at least I'm confident that I have a margin of safety, especially compared to those guys from a year ago.
Are we sure that they are still holding the stock?
Last time I checked, they were not selling. The last time was for Q4 when they shared mid-February. They shared for what they held at the end of Q4. So I will publish an article on Siking next month that covers like if there were some big sales. But UiPath was not part of the companies that they are selling, at least in Q4. To conclude on valuation, I have two graphs that I like to build, and I update this regularly. It shows on the left side the rule of 40, so operating profit margin on the vertical and sales growth on the horizontal chart. So you can see Path is here, about 50% revenue growth. So ARR is higher, revenue is a little bit lagging, or we discussed that. And if I use their trailing 12 months profit margin, it's actually less than 50%. Is really bad. But as we just touched on, it's negative 18% in Q4, right? So Unity is the closest comp. You can see them here. And really, when you think about it, the profitability, instead of being minus 55 like it is right now, it's going to improve toward minus 20 or something like that in FY23. We already know that because the stock-based compensation was creating the big loss. So it's going to look closer to something like Elastic here, but also Five9. But keep in mind, the growth profile of the company is much closer to Unity. Unity grew north of 40%. They have a dollar-based net retention of 140. So they are slightly better than Unity for that. And Unity's guidance for FY23 is 35% growth. So somewhat similar of what UiPath management was aiming at. And look at Unity here. This is enterprise value divided by revenue of the past 12 months. So it's not perfect. It's just to show, compared to the last 12 months of sales, what is the valuation right now? And Unity is trading north of 20 times sales. So you have UiPath here that has a very similar growth profile and arguably better margins based on what we've seen as the trend in Q4. And Path trades at less than half of Unity's valuation. So again, it doesn't mean load the truck. Like for me, UiPath is actually like less than 2% of my portfolio in terms of the cost basis, the position size. I'm very happy with that. At this point, I'm not increasing my position necessarily more because I want to see evidence, in FY23 of the risk you pointed out to. But at least it gives me this comfort of right now between the two. And Unity is a portfolio position of mine. I'm a happy shareholder of Unity. But if I had to choose between the two, given the current circumstances, I'd rather build up my Path position at this moment, right? And that's what makes UiPath a best buy now. That's how I like to put it, because that's this timely opportunity, right, that I try to strive for every month. The combination of quality business momentum, but also the timing, the opportunity to accumulate more shares.
All right.
So that's UiPath.
Thank you so much for the passionate explanation. I can see that from your presentation that you are full of energy and passion on your investment. And I can see that UiPass has become very attractive, the opportunity. I have been actually investing in UiPass for more than 1 year, since 2020. And recently I sold the stock because of the risk side of the story. And you are right. At the moment, the valuation has come down dramatically, not because of the fundamental, but because of the external factors and also the macro side of the story. And hopefully, that we will continue to see the growth story of UiPath, especially in terms of the competition with the Microsoft. And if that is the case, if we can see the evidence of the growth competing other bigger companies, yeah, we might have a great opportunity here with UiPath, ticker name PATH. Okay. Yep. Thank you again for the very detailed explanation and analysis of the stock. I cannot wait to see the next name of the stock recommendation next month. On behalf of the Mijuun family, thank you for sparing your valuable time to give us all the information. So I will see you in about 1 month's time then.
I love it. Yeah, looking forward to it, Charles. I really enjoyed my time here. Love the opportunity to chat with you, and yeah, looking forward to the next time.
Thank you, and have a great rest. You deserve it.
All right,
Bye-bye.
take care.
Bye.
Bye bye.